We are now ready to commence with our panel discussion, and I'll take the pleasure and the privilege inviting our illustrious panelists up on stage, and of course, inviting you to join in their welcome with a nice warm round of applause. We have amongst us, ladies and gentlemen, Mr. Santosh Navlani, Chief Operating Officer, ET Money. I'd like to welcome him up on stage. Welcome, sir. I'd also like to welcome Mr. Subramanya SV, CEO, Grow Wealth. Welcome, sir. Please do join us on stage. I'd like to welcome Mr. Swarup Mohanty, Vice Chairman and CEO, Mirae Asset Investment Managers. Welcome. Do join us on stage. I'd like to welcome Mr. Vetri Subramaniam, Managing Director and CEO, Designate UTI Asset Management Company. Welcome, sir. We'd like to welcome Mr. Vishal Dhawan, Founder and CEO at Plan Ahead Wealth Advisories. Welcome, sir. Do join us. And our moderator for this session is Mr. Vetri Mahanta, Chief General Manager, MIRSD, Securities and Exchange Board of India. Welcome, sir. Thank you so very much, gentlemen. I request you to all to kindly take a seat. And with that, I'd like to hand over to our moderator, Mr. Vishal Dhawan. Sir, do take this session forward.
Good evening, everybody, and a warm welcome to this session. First of all, I'd like to take this opportunity to thank the SEBI team and the GFF team for having me as a moderator for this session with esteemed panelists. So, as you know, the name of the session is name of the session is Artificial Intelligence in Advisory, that is balancing innovation, bias, product suitability, and investor protection. Quite a long topic, and there are many facets to it. So, before we dive into the discussion, I'd just like to put a little bit of context to the whole thing. This theme is sitting right at the intersection of three components, that is markets, technology, and regulation. So, if you have seen over the past few years, we have seen retail participation in securities market increase exponentially. So, looking at the figures for the mutual fund AUM, we see they have crossed 75 trillion. That's as on August 31st, 2025. And we have more than 12 crore unique PANs registered with the depositories. And a significant proportion of those belong to retail participants. So most of these retail participants have been onboarded through digital platforms, and that has led to also a surge in investments from retail participants. Secondly, when I talk about technology, with the advent of ChatGPT in November 2022, we have seen like progressively moving from just being a buzzword to its role in mainstream financial services. It's increasingly taking a bigger role. And probably the appeal lies in the fact that AI is like it brings personalization at a large scale. It is low cost, it gives low cost advice, and it has helped first time investors into the markets with a lot of confidence. And for a country like India, where financial inclusion is a very big priority, so I think this helps in the appeal of AI rising further. But having said that, I think there are also risks which are fraught and entailing with the rise of AI in advisory or any securities market product in general. So, as we all know, as a layman also would know that AI is as good as the data it is trained on. So, when we have deficiencies in this data, there are problems which can give rise to incorrect advice, bias in the advice which is given by models. It can also lead to, in the case of fund management as well as in advisory, fund management being that there could be distortions in product design, there could be distortions in stock selection or portfolio analytics. So one has to be very mindful about these aspects. And the fact that most of AI models are black boxes, that also brings quite a bit of opaqueness and non-transparency to the whole process. So now where does regulation fit in? So what I can tell you a little bit about what SEBI has done in the past. So SEBI for algorithmic driven products has laid more emphasis on disclosures. And if, like in 2024, specifically for investment advisory regulations, we have brought in some responsibilities solely on the advisor, like regarding the protection of client data and the integrity, confidentiality, and any data that is relied on for advisory being the sole responsibility for, we have placed it on the advisor. Now, having said that, before we dive into this session, I just inform everyone that we are structuring this discussion into 3 rounds because this topic has 3 facets to it. The first is innovation, that is how AI is being used in the respective industries. Second is how do we address the bias and the entailing product suitability for clients. And lastly, the most important piece of it will be investor protection. How do we bring about investor protection in this sphere? So, I'd just like to invite for the first question, which, as I mentioned, is about innovation, like how respective industries are using using AI for their respective products. So, I would run this question across Santosh, you, and Subramanya, you, and Vetri. So, maybe one by one, we can just give a little bit of like where exactly you're using AI in your respective industries, and how is the value addition happening? Like which are the exact spheres that you see that value addition?
Yeah, so I will speak from ED Money standpoint of what we are doing since the question is innovation here. I think most of the companies in the space have been wanting to leverage the capabilities of AI in terms of how do we personalize communication, how do we use the power of AI to actually recommend the right products to the customers, as well as ensure that at the same time suitability is not compromised. But given the risks that are at play, because there's real money involved, and the quantum is only controlled by the customers, it can be small amount, it can be large amount. We've been refraining from really applying it to the customer-facing functions, but one experiment which we are about to ship out in the next couple of weeks on ED Money app is actually where the explanation for the advice is being done using AI. So let me give an example. Today, as an advisor, what happens is when a customer or investor comes in and does his risk profiling and expresses the interest to invest, provides information about his investments goals, her investment tenure or the objective, there is always a con model at the back end which calculates a lot of things and recommends a product or a portfolio strategy to the customer. But most of these times what we've been doing is explain the rationale behind the investment decision through illustrations, graphs, charts, and more of statistical parameters. Now that is not human way of communicating, and actually explaining in a language which is more of like in a format which is linguistic becomes very difficult at scale, because you're dealing with millions of customers, hundreds of use cases, and insane amount of possibilities, because some people are investing for short term, somebody is for long term, somebody is aggressive, somebody is conservative. Markets sometimes are in a bullish mode or a bearish mode or a sideways. Now you cannot really have a different kind of communication coming out every time by human imagination here. So what we're doing is basically adding explanation of advice, rationale of investment, which is probably the biggest determinant of delivering confidence to the customers or the clarity in decision using AI. So somebody who's aggressive and he's investing for long term may see context of market which is right now in this point of time, actually reflecting in the rationale instead of just plain numbers led decision. We believe that can actually aid a lot of confidence and help people stay invested. So when you understand and take decisions and then invest, the chances of you staying invested for the right amount of time is higher. And that's what basically aids compounding. So our objective behind this is, can we really help people take more informed decisions and not just deliver decisions via this innovation? Thanks.
Thanks.
Yeah, so I think use of AI internally for us has 2 parts. One is I think literally there's an internal facing functions and customer facing part. I think internal facing, there's hardly a function where, AI is not being used. Marketing, technology, product, you name a function, because there, whatever wrong happens, it's under control. So I would say probably every function there is application of AI. Obviously, we have to be super careful when it comes to customers, because we don't want to send something or tell something customer that the engine could do wrong. But I think there are a couple of use cases where there is reasonably large scale application right now as we speak. One is this is in the realm of customer management. I think one is customer communication. I think today we are able to personalize communication at a fairly large scale, which was not possible. Each of us could have different portfolios, different stocks, different mutual funds. Let's say Nifty corrects by 1% or goes up by 1%, instead of all of us getting the same copy-canned email every single day, each of us could get different emails, and that's happening as we speak. I think content personalization is a reality, and the beauty of this is it's happening without customers realizing it. That's the best thing, when the customers don't realize, look, this is happening. I think the second use, which is already here, is a lot of enterprises are also using, is customer experience, ability to solve customers' queries without having to stand in a queue for 3 minutes. All of us have an experience where you're on a hold, or you read an email, you raise a chat query, it takes like few minutes to few hours to get the response. I think today the models are with our own data, it's strong enough that a significant percentage, say more than 50% of the queries are getting resolved without a human intervention. So some of these customer facing, what I would call as customer management, are all here and now, they're all real. What more can we do? We can talk about later, but those are some of the examples of customer facing situations where we are already using AI. Of course, internally, as I said, many of the functions are extensively using AI, including coding.
Vetri, would you like to?
Sure. So maybe first, just useful to put things in a little down of a perspective. When I think about this in terms of the usage of AI, one is whether you use it as a tool for some end purpose, and second is whether you are actually using it as almost a free radical capable of taking independent decisions. I think at the stage and context that we are at this point of time, the use of AI is limited to it essentially being a tool rather than a free agent capable of taking decisions. So the way in which it gets used, and some of panelists have already spoken about that, it gets used extensively by our digital marketing team because they're able to use it to personalize content at scale. It also gets used in call centers where incoming customers sometimes may actually be interacting with agentic AI, but if it leads to a transaction, it eventually will hand over to an actual human being to complete it. So these are two very simple sort of use cases which are in the nature of tools being used to give you the benefits of scale, efficiency, cost, so on and so forth. It also gets used in the middle office where we are still in a stage where there is some paper within the system, and so we can use AI to sort of automate the paper, so to speak, into our workflow. When I think about using AI as a free radical capable of taking decisions, we don't do that at this point of time. When it comes to investment management, which sits at the core of the investment management business, again, we are looking at the use of AI as a tool to essentially be used by analysts or by fund managers to allow them to be able to take better decisions by making more information available to them, by improving the turnaround times at which information can be provided to them. It could also be used, to do trend analysis, to look through, we know for a fact that we've got years and years of research reports written by our own internal analysts over time, and nobody actually has the time and effort to go back and look at the last 5 years, 7 years of our own reports and understand how our thought processes have changed. And that's a very simple use case for which we can use AI as a tool, essentially to give us a map of how our own thought processes have evolved over time. But to cut a long story short, in all these cases, essentially decision making stays with the individuals, particularly as far as investment management is concerned. So we are essentially using it as a tool. The benefits are typically efficiency, cost, and to be able to do things at a particular scale. So that's the way we've been using AI so far.
So, Subbu, you mentioned about the customer experience, and Vetri, you mentioned about the scale, the element of scale that you're using. So, do you think it helps in financial? Has it played any positive role in acquiring customers? That's moving beyond the existing set of customers to acquire more customers and thereby aiding financial inclusion?
No, not yet. I don't think it's being used as a customer acquisition tool, but it's certainly helping in customer NPS retention and as a derivative effect of customers being happy and referring other customers. But in areas like marketing, etc., right? Like performance marketing, digital marketing, all those require lots of data analysis, lots of running 5 different campaigns, what's working, what's not working. All of them needed analysts to sit and do, and I don't think going forward, we're at a stage where a lot of that, Google AdWords optimization, to the extent Google AdWords are effective, because that itself is a question mark, because people are not searching anymore. They're searching for, Gemini summary. I think some of those efficiencies are there, but they're not customer facing.
When you talk about scale, you want to also say that whether it has led to more of customer acquisition, have you been able to target products more specifically at?
Absolutely. So on the digital marketing side, that's what our team is able to do now. One, they're able to generate images literally on the fly to be able to target particular segments based on the information that we have about that customer. So it makes for far more effective conversations with the client. And of course, it's a hook to get the client as well. So what they have noticed is their ability both to turn around campaigns to stay current and the ability to get customers at a lower cost. That has certainly improved without doubt.
Thank you. So I think we are partially achieving the goal of financial inclusion and also a better customer experience. Now, coming to the second part of the discussion, I would like to invite Santosh, Vishal, and Mr. Swarup. So, we heard from the industry that now the usage is not it is not at a whole scale level. There are partial uses for AI in advisory as well as in fund management. There's still an element of human decision. It's not completely left to the machine to do everything. So, how do you think, is there a case for bias creeping in at this stage when the model is not being used in a wholesome manner? And is there any, are there any concerns related to product suitability, or in case of fund management, let's say, when you target products, like the product design or the portfolio selection in the portfolio analytics? So, maybe we can hear some thoughts on that.
Probably all of us spoke on this, that none of us is probably using AI to do the real delivery of advice or recommendation to the end investor, given the risk of even 1 in 100 might going wrong is way too high because of the money involved here. But on the question of bias, I think be it a human advisor or be it an AI-led model, I think bias is going to be inherent. It's about how do we define guardrails around it. So for example, if we look from an advisory standpoint, an advisor is always looking at how do we ensure that the product or the investment portfolio that we're building for the client is actually an outcome oriented in a way that what the client intends to do without compromising the suitability of its risk profiling. At the same time, also kind of, staying true to the philosophy that they buy. So philosophy, for example, we have is basically ensuring that we deliver better risk-adjusted returns, not better returns in isolation. because the idea is that to increase the time of investment enough that the compounding catches up over a period of time instead of one being lucky with one investment decision. So when we think from that standpoint, as of now, we are not really leveraging AI for product decisions. What we are doing is for communication, as I mentioned. But we would love to do some things which we are planning to do over a period of time is how do we, so today all our models are quantitative and behavioral analytics based. And when we are using the models to deliver any investment advice to the client, it's actually something which has been back tested, which has been kind of stress tested against different market environments, proved for risk and return trade-offs that it will go against the churn in the portfolio or for the tax of those investment decisions. The idea is that can we really expedite the improvement in our modeling over a period of time with the help of AI. So today, we always require a few engineers to work together to plan scenarios, to imagine things, to leverage the current market environment and say this is the interesting thing happening and we could have captured through the signals. It's all human-led. Can AI do a lot of discovery of these signals and in the interplay there and help improve the model on its own? Now, we may not ship out to the production and apply the enhancement directly, but the idea is can we really use those insights and do testing around that, prove that it actually fits the investment philosophy, and then ship out into production. So we intend to do that over a period of time, but as of now, we are not there yet.
Vishal, some thoughts from you?
So I think there are two things here. One is clearly the thing around, biases exist both at an advisor level and at a client level. So I think one of the first things we need to be mindful of is to come from both places, not from a single place. And if you have AI sort of looking at data, you don't know whether the bias that comes out from the output comes because of the way the AI has been put a question. So as everyone prompts an AI tool, the question is, depending on how you ask the question, you'll get a response accordingly. Secondly, depending on which Gen AI tool you use, you could also get different responses coming in accordingly. And those are built around the data sets that they're using at the back end. So we need to be mindful that there is inherently bias coming from here. We do a lot of test cases internally. We don't use it for external customers, but one of the most common things that a lot of people in our team do is ask very simple questions that investors normally ask them. For example, what should my expected rate of return be in the next 12 months? I think it's a common question. Depending on which Gen AI tool you put it into, you will get different responses. Some will have a certain level of certainty, as if they know the answer. Some of them will give you probabilistic outcomes, and some of them will give you that answer depending on whether they're looking at shorter-term data or longer-term data. So now the question for us as an advisor is, which of those Gen AI tools is real? And obviously that bias exists even for us as advisors, because if we are sort of thinking long-term, we may think about it very differently from thinking about a one-year view. So we have to keep this reality in mind. The second part of it is how do you really look at suitability, right? So as an investment advisor, the regulations are very clear. They define how an investment advisor needs to look at a client. And it defines risk appetite, it defines income levels, it defines financial goals, defines time horizon. So it's all embedded in the regulation. And the AI engines today are not designed keeping regulation in mind on one side. As far as products are concerned, one aspect of a product is obviously returns, and that tends to get a lot of attention. But there are many other aspects. How much risk is taken? What's the kind of liquidity on that asset? What kind of tax efficiency exists? What's the kind of costs? Is it something that is new versus old, because the amount of data available for it could vary. So again, what you end up finding is that you need the AI model to become an input into your process so that you can then do a fiduciary role. So essentially the way we look at it is AI goes into a human being, that human advisor sort of vets it, looks at biases that he or she may have, which means that that may need one more round of vetting by another human being, and then puts it in the lens of the fiduciary role that an advisor plays. And that's how you can probably seal it in some sort of a manner where it's acceptable to a consumer and it's acceptable to the regulator as well.
Thank you. So maybe we can hear how fund management, you're wanting to tackle the same
Yeah,
problem.
I think from an advice perspective, bias is very inherent because the underlying model, like Vishal rightly pointed out, is based on history. And history is not exactly neutral. As history starts playing out, that will pay out. But when you look at advice, it has two parts. If you are expecting an AI model to predict the markets, your guess is as good as mine, right? Because markets are dynamic. But if you are expecting AI to find predictive tools to finding financial goals, I think it can do a far superior job. Just given, but it's always give and take. Is how much the client puts in will then enable the AI to sort of gather out. So just to give you a small example, I have to feed in that my son has gone into this school. Then can easily done a run on the school fees across the world to predict that, these school fees are not what you are predicting, it's going in this trajectory. It can help predict your financial goal implications in a far superior, non-subjective manner than, say, just predicting markets. So at the same time, it's as simple as, say, the Waymo working very effectively in San Francisco, and a driverless car cannot work effectively in India because the underlying data needs to be cleaned up. Now, between now and the data cleanup is where all this biasness comes in, and that's why it's very important to make it still hybrid, like Vetri pointed out, maybe use it like a tool rather than use it like a solution. But I'm pretty sure that one day when the data is cleaned up, it will drive on its own. So while we can run our maker checker on it, make no mistake that the machine will start learning on its own based on your impact. Finally, it's garbage in, garbage out. The more data you feed in, the more it learns. The difference between an algo or a robo and an AI is it will learn. The more you feed in, the better it will be. And there is a human restriction to how much we can do. But the machine can do much more than that and can do it in an unemotional and non-subjective matter. So to predict goals and assist people in goals, I think it can do far superior work than a subjective human can do because of the data availability on it.
That gives a lot of comfort to the regulators, because the hybrid model, I think, solves a lot of the problem of bias and product suitability not being in order. So it is pleasant for the ears of the regulator to hear that. So having said that, when we come to the last piece, like the final piece, that is investor protection. So right now the approach is more disclosure based. So do you think that this is sufficient, or the regulator needs to do more disclosures? Apart from disclosure, is there something more that we need to do for investor protection? So first, I would like to ask Subbu, you to respond.
I think the issue here, to me, from a customer perspective, is consent. From a data perspective, we could use a lot of information to personalize. For example, today customers leave a lot of digital footprint. That's available. You could use that and synthesize before the first conversation. By the time the customer is in the first session of the app or first meeting, you have more information than the customer has actually provided to you, right? Like, can we use that information for personalization, product proposition? Those are at this point of unknowns. Can we use, can we not use? And this is not the data the customer has given to us via consent, but it's just available. It's just available. The customer has voluntarily left this on the digital footprint, right? So using that data to make products available either digitally or in person has its own repercussions. So what data can we use? Can we not? Can we use only data that the customer has actually provided via consent? And only that can be put through a model. And even their restrictions in terms of what the customer's data can be used for. Like, can I use a customer's data for large-scale pattern matching across customers? At this point in time, I don't think that's a consent being sought from the customer, which we don't know whether we can or we cannot. So some of those questions are still not clear yet, if you will.
Vishal, any thoughts that you may have?
Yeah, so it's quite a challenge because IOSCO recently did a study and they found that when they went out to respondents, they said they use AI in at least 25 different ways in their advisory businesses. And these are only where there was a certain percentage of people who said, I use it for this purpose. So I'm assuming there's a long tail on top of that. So what it then needs to do is go out and make sense to all of these people. Now, how do you explain those 25 use cases to investors when they probably don't understand the technicalities of AI? So disclosing, saying that I use AI in my business is probably not enough. I use AI to recommend the stock that you're buying. I think that makes it more powerful. I use AI as a process enhancement tool versus, to give me more strategy time or more customer relationship time. I think that's not probably enough. I think you need to break down the process, explain where you're using it, because for someone who's then reading that disclosure, and not obviously in font size 4, it needs to be a one-page sort of disclosure explaining that these are the parts of my business that I use AI in. I think once you've done that and you've done investor education, just the same way as you had to educate investors about many other aspects, investing in mutual funds do not depend on past performance. I mean, a lot of that had to work over the years for people to finally get or hopefully get the message that, past performance is not indicator of future performance. Smoking, right? Great example. Cigarette smoking is injurious to health. It isn't as powerful until you put those images up there, which are very, very powerful when you have those films running in theaters where you see, people impacted through cigarette smoking. I think that's the next stage of where disclosures will need to move to for AI, because I think it needs to move to contextuality. I think the investor needs to understand how it impacts me rather than just a single line or 2 lines saying I use it for the following purpose. And I think that's where it'll move to. I think SEBI is doing some work already on it. There was an AI ML paper in June that got released. It sort of moved responsibility to the board. I think, it's a good start. Probably the next stage will be where it will require much more detailing in terms of what needs to be done so that some of the risks around using AI is aware, the investor is also aware of it at the same time.
Some thoughts maybe from the mutual fund industry, as you are the largest
Yeah, I think
retail money.
it's a very important time and very important for us to address this at the beginning, because what is happening today is pretty incredible. An individual is very comfortable sharing his or her very intimate and personal data online rather than sharing it with another individual. So the data that is available online is pretty sensitive. And what we do with that data, because we run a fiduciary role, is extremely important. How we tell the customer or our investor what we will do and how it will impact that person is extremely critical. And how we will use, especially the financial data, is to be put up not in a small font at all. And like Vishal rightly said, that mutual funds are subject to market risk, had its journey. We've learned from that. And maybe day one, come out and put it out in the open, explain it very explicitly. Because the data is out there. And everything and anything that you want to get is available. By the small yes at the bottom, he or she is actually giving us access to her own life without her own knowing. And that is where it is very critical for all of us to take that part very, very seriously and communicate fearlessly and very explicitly on the impact of that data on that individual. And after that, take an yes. If we go to that stage at the beginning, what we can do is unimaginable. Then the data that we will get is absolutely cleaned up. The data lake that we will form can be put to some unimaginable use. In the absence of that, we will always be held responsible for misleading people. We unnecessarily attract the regulator the wrong way. Once we've learned it, why get into it? Just take it on head on. This financialization of data is happening. It's the youngest country in the world. if we address that day one, I think what can happen to us as a country is pretty different from a lot of other economies, is my submission. We have to uphold the fiduciary responsibility there to the hilt. I'd like Vetri's reaction on this one because he's been the fund manager, I have not been one. But maybe Vetri.
Sure. So, just change tracks here. So if you remember when you were maybe in school and doing maths, right? And you have a particular question which is put up to you, and the teacher would always tell you, it's a 5-mark question. If you get the answer right, and you only write the answer, I'll only give you 1 mark. But if you want the full 5 marks, you've got to show me the workings and then put the answer over there. And I think that's a very important disclosure which needs to go into AI, which is to say that when you have that black box, you don't just put the final output there, yes, no, 30, 40, no. There has to be an explainability of how you got there. And this is something that increasingly is being seen as a best practice, that anything which is an AI-driven output must have explainability behind it. So as simple as what maybe my 5th standard maths teacher told me, and I heard, learned that lesson the hard way. So that's point number 1. Point number 2, again, I think coming back not to the disclosure angle, but to checking how well that AI model works. We already have a system for this which we use on the cyber side, right? Which is you not only have internal teams who challenge the model, but you have external teams which challenge the model. And challenging the model is once again a best practice recommended by most regulators across the world, even in areas where companies and banks use a risk management model. It's a standing practice that you must challenge the model from the outside. So I think if you build explainability into your system, if you build external challenges to the system into the monitoring mechanism that you have, then I think you can take care of many of those roles. And in a lighter vein, the more I read about this, I'm not so worried about AI taking away jobs. I see a bright future in compliance and risk and people running challenges, in the job market for people doing those kind of functions. And if you'll bear with me, Bitin, just one point which you asked on the fund management, I wanted to give you sort of my sense of it, because as Swarup said, I've been a fund manager all my life. See, fund management is neither pure art, nor is it pure science. Right? It's a combination of two. And it's very interesting when you look at that, because Harvard has done a series of studies on a very different domain, which is radiology reports, right? And, when you get that radiology report, interpreting it is part science, part art. We know that there are differences. And when Harvard looked at providing an AI tool to radiologists to interpret that report, they found that the results were all over the place. There were poorly performing radiologists who did better. There were high-performing radiologists who did worse when they were actually given the AI assistant. So actually what Harvard's conclusion at the end, and they've been doing these studies for almost 3 years now, they've been trying to develop the AI tool, is that you actually need to develop personalized AI assistants for every radiologist. Because every radiologist has a different thought process in his brain, in his DNA, which he or she is using. And effectively, the AI should be used as a personal assistant, literally like an alter ego, right? To maybe cover for the defects you have in your thinking system. So I think maybe in the investment management, part of this, the decisions may still be driven by humans, but I think that's an interesting way in which AI can get used to cover the known biases that individuals have. But again, you don't do the average solution, you customize for each individual.
Thank you so much. That's very insightful. So now I think we have time for maybe one quick sentence from all of you regarding, what do you think about the future of AI in securities market in your respective industries, and how will you handle the risks associated?
So I think I touched upon the aspect that we would love to put AI to use in terms of enhancing our speed or enhancements to our quantitative modeling way of doing things, where we are not dependent on the human imagination to find interplay of different market signals and factors on portfolio construction, but let the AI guide us that there are possibilities like these. We didn't decide which possibility to put to test, and based on the results, we actually pushed into production. So that will be actually far more impactful in terms of ensuring continuous product suitability, ensuring risk management in the portfolios, proactive decisioning, multiple things. So I think for us, the biggest use cases in front of us, we'll see how we can put it to use.
Yeah, so before I get there, Vetri, I think matter of time before the AI engine will read the radiographs without it's like, I think it's a question of time versus the accuracy. It's just time is a raw material for some of these models, and as we give more time, it will happen. Doesn't mean investment management can be done by AI, for sure, because a radiograph is, not to belabor the point, but radiograph is a historical data point, whereas investment is futuristic. But I think, frankly, the roadmap on AI is frankly a function of what the regulator allows us to do. So, but I think within the realm of what's available, can we, one of the objectives is I think we can do hyper personalization to the customer based on the customer's consent. A few years ago, the only people who could do profiling were social media, because you leave a lot of data on social media. But I think with so much of digital usage, any technology company, frankly, any company can profile a user. Not based on third-party data, just on the data activity levels that's left by the user on their own platform. So the data that's on the platform is proprietary data. So I think that can be, with the consent of user, there can be hyper-personalization. I think prevention of mis-selling is a good use case. We didn't get a chance to talk about that, but I think both on the digital side, nudges have been rule-based. Like, if a customer is trying to buy a penny stock, the nudge is rule-based, whereas that I think can be a lot more AI-driven. In an offline setting where relationship managers are selling products to customers, or in a virtual setup, today ability for the organization to have a view of what's exactly being talked about without by reducing mis-selling. I think that's a very, very powerful use case, and I think the early results are very positive on that front.
So I think there are two jobs in front of us. One is for advisors and advisory teams, and the other is for the customer. I think for the advisor and advisory team, I think the challenge is to help the advisor and the team believe that this is a really good friend that you have now by your side, in whose company you can thrive. A little bit like Abhishek and Shubman Gill playing cricket together and sort of building on each other, rather than believing that this is your enemy and this could take your job away. And I think a lot of what we will have to do as leaders in our businesses will be to help people in our teams accept that this is not going to take away our job, but going to allow us to do our job better and allow us to serve customers better on one side. So that's one sort of future that I see over the next 6 months to a year. As far as customers are concerned, again, I think it's a very nuanced sort of response that is needed. I think what good AI can do is simplify, but what it can also do is oversimplify. And if you oversimplify things without giving it context, you could have a problem. I'm going to use a very simple example of compounding, right? So I think if you go into any AI engine and put compounding, it will do some math and show you, how much your money will grow to in 20, 25 years. What it will not talk about is how do you do patience when markets go down? How do you stay disciplined? How do you ensure that you don't put money into equities for compounding if you need it after a year? I think those are the areas where customers could actually need a lot of help from human advice to actually tell them that, yes, the math will now get solved by AI. We need to come there and solve all the other things about it and around it, which are equally or probably even more important.
Sure. So I think just in terms of what could be done, as I mentioned earlier, to my mind on the investment process, there's a lot can be built in terms of AI, just to smoothen the process. Make sure that all data and facts that should have been looked at before you get to a decision-making point, you use AI to sort of make sure that is presented to a team. And I've already experienced this, and this is literally using the off-the-shelf AI solutions which are available. And I joke about this with my team that, today the AI program gives me a research report on a stock faster than I can get it from my own team members. And I understand that, they go through their own diligence and studying of documents before they do it. But the harsh reality is that the AI program gives it faster. So I think we've just got to figure out how to live with that. Can we use that as an initial screening device? We are having a lot of internal discussions, and I'd be very surprised if a year from now we're not able to say that, look, we can get the initial screen just out of AI, tailoring it to keep in mind our investment process. The challenge for us at this point of time when we've looked at such things is that if you try to build it, it's too expensive. You can't custom build this from, point zero at this point of time. So you've got to work with the off-the-market solutions which are there and see how you can customize it. And to Subbu's point, one day I will believe, whenever the regulator gives permission, there will be a completely AI-driven mutual fund where the fund manager will be an AI program. So it will happen. I have no doubts about that.
Yeah, I think we are at an exciting time. I mean, for us, let's face the reality, we are already in a fetch world. When we type from X to Y direction, we don't ask Google ko kaisa pata kiya hai. We already believe it, right? And that impact will come on everything. From customer service to fund management, the challenge is to build agents like Vetri Lives. And when it comes to AI, it all boils down to the sensitivity of everything. It can easily find out from an email of mine with a new word that I've used and scan all my communication and say that this word I have not used, so maybe this email is more sensitive than my previous one and it'll help me service the customer better. It can easily tell my sales guy that, hey, maybe these are large distributors who are not going, so go there. Predictive can work very powerful with AI. And like Vetri said, can we then produce an individual agent to all the analysts? Analysis is dead already. They just need to fetch. And that can be so much time consuming, as efficient, that they will be able to do far more work than they used to do in their 8 hours. And that's where this is leading to. And it's got us we have a very strong team at the back end. We formed our agreements with the data lake provider. We're getting everything on the paper, and hopefully in 2 years' time, we should be able to put an agent for all the departments. That's where we are poised now. But yes, exciting times because it saves a lot of money. What we used to do in 8 hours, we'll probably do in half an hour. It frees us to do other things in 7.5 hours.
Thank you. That was very insightful. So we could go on and on, but I think we are just, can we have questions? Is there time for questions? No. Okay, I think the screen is red, time's up. So thank you to all the panelists and also to the audience for being attentive and giving us a patient hearing. Thank you.
Thank you so very much, gentlemen. If you can kindly step forward for the group photograph, please. Ladies and gentlemen, it's been an absolutely fabulous round of discussion. AI and advisory, balancing innovation, binds, product suitability, and investor protection. And we'd like to thank Mr. Santosh, Navlani, Mr. Subramaniam SV, Mr. Swarup Mohanty, Mr. Vetri Subramaniam, Mr. Vishal, Dhawan, and thank you, Mr. Vetri Mohanty, for moderating such an insightful session.